Chapter 8 defines rules on 5 factors that affect your credit score. I have a few rulers taped on how to manage each one of these 5 factors that affect your credit. 1, 35 payment history. 2, 30 utilization. 3, 15 types of credit. 4, 10 age of file. 5, 10 inquiries new credit. By now, you should have a clear understanding of what affects your credit score. I hope I was able to clear many misconceptions or misrepresentations you may have thought about what truly affects your credit. It's important, though, to know how to manage your file to make sure you ultimately always have perfect credit, and also to position yourself to have a strong profile that continuously increases your borrowing power. That is the point of managing your credit, not so that you can sleep well at night. That is not the reason why you are interested in having good credit. You want to have good credit so you can increase your borrowing power and get attractive financing terms. So let's go over some of my rules on maintaining and managing your credit properly. There are times that you are seeking funding, and there are times when you are not seeking funding, what I consider coasting. There is a difference between how your credit needs to be when you are seeking funding and how your credit needs to be when coasting. As I go over my rules, I will go over the general rule about each one of the 5 factors. I will also go over what the rules should be when you are seeking funding and when you are not seeking funding, aka coasting with your credit. 35 credit history management tips. Your payment history on your credit profile reflects 35 of your score, which is simply making your payment on time. So the basic rule is you need to make sure you have some type of trad line that you are making a payment on every single month. I gave you an example earlier of the client I had who was a farmer who wanted to get capital to expand his business. He was under the assumption that he had great credit since he paid all his vendors in cash. This is a big misconception that most consumers have, thinking that if they pay everything in cash, they should have good credit. Well, surprise, surprise. Credit bureaus are not God. They do not watch transactions that are not reported to them. So make sure that you have active trade-the-line accounts that you pay on that are being reported to the credit bureaus. The next tip as it pertains to payment history is to make sure you are making your payments on time. I know this should be common sense by now, but I cannot stress this enough. Make sure your payment, especially on travel and half accounts being reported to your credit report, is on time. Do not go over 30 days late on your payment, or it will be recorded with the credit bureaus and can stay on your report for up to 7 years. Also, making your payment on time will help you save big money on fees, as mentioned before. One of the tips on how to save money while dealing with banks is staying away from late fees. This is one of those unnecessary lenders things you want to stay away from. I also want to add that you should try to always make more than the minimum payments, especially when you are dealing with credit card interest rates, which are usually higher on unsecured accounts. Pay more than the minimum payment so you can save on interest. I suggest you pay above or even double the minimum payment so you can save on interest. These are just a few tips to help manage the payment history factor of your credit report. 30 available credit challengization. Management tips. Now let's go over some management tips on the second largest factor that affects your credit, which is available credit. To jog your memory, utilization is balances in relation to limits on all revolving accounts. Example, Capital One credit card with $250 balance and $1,000 limit is 25 utilized. So there are a few rules here I want you to keep in mind on how to manage your utilization when you are shopping for financing and when you are not seeking financing. The first general rule is you must have revolving accounts in order for you to benefit from this factor. Keep in mind, this calculates your available credit, and the only type of accounts that give you access to credit are unsecured accounts. The myth that you can have good credit without establishing unsecured accounts is simply not true. If you do not have any credit cards, that is where you need to start. But the general rule is you must have unsecured accounts to benefit from this factor. Secondly, as you are maintaining your credit, you want to keep your balances below 50 of the available limit at all times. This will make sure your score is not negatively affected by your revolving account balances. And when you are shopping for financing, the best way to position yourself is to lower the balances down below 30 SEWE, which is recommended. To be clear, there are two things I am saying here. I will explain why here in just a second. But when you are shopping for funding, Drop your balances down below 30 of the available limit, and when you are not seeking funding, you can increase your balances up to 50 of the available credit. It's recommended that you actually increase your balances to 50 at times, and this is why. First off, the reason why I recommend that your balances need to be below 30 when seeking funding is that it has been shown based on the FICO algorithm that 30 and lower is when your score truly benefits from the available credit factor. I believe it goes back to my old joke. Banks only lend money to people who don't look like they need money. If your balances are on the high side when you are seeking funding, this is one of the factors that the underwriters look at. You are considered to be high risk or desperate, which is, of course, backward from the consumer mindset because most people would tap into all their resources plus their credit card before they seek out financing in most cases. But again, understanding this will help you know how the underwriters look at things. So this is the reason you want the balances below 30 when seeking funding due to how the FICO scoring algorithm works and underwriters' mindset about utilization. The reason I recommend that you increase your balances up to 50 of what the available limit is because one of the things that is tracked with revolving accounts is high balance, also known as high credit. The highest past balance may also be called high balance or high credit. This figure is the highest balance you have owed on a specific credit card account or loan during a particular period of time. When it comes to credit cards, high credit may be the highest balance you've carried on your credit card over the last 36 months or more. It's important that you create a history of high past balance, and this is why when lenders approve your application for any type of unsecured capital, my theory is the next decision the underwriter has to determine is how much money they will be able to extend to you. I believe a big part of this decision is based on your previous high past balances. Let me give you a real world example to make it make sense. Let's just say you have two identical twins that both bank with the same bank and they both reach out to the bank seeking an unsecured line of credit. Let's also assume they both have the same score. They each have a 700 FICO score. Also, assume they have the same type of business in the same industry. The only thing that makes them different is that one of the twins has 3 credit cards with a limit greater than $5,000. Let's just say one of them has a $5,000 limit and the other 2 credit lines have a $10,000 limit, which gives you a total of $25 in total unsecured credit. But his twin has 3 credit cards, one with a $300 balance, the other 2 with a $500 limit, each with a grand total of $1,300 of unsecured credit. Now, and the first twin with the larger limits has a high pass balance that reflects $15, $20 total, and the other twin, given the total limit on his cards, only has a high pass balance between $500 and total high pass balance. The question is now, if they both apply for the same line of credit product at the same bank, who do you think would qualify for the larger amount? Well, clearly, the twin with the higher limit cards and also with the higher pass balances. The other gentleman with the lower limit cards and lower high pass balances would not be able to qualify for the same amount as the higher limit individual, regardless if they have the same score. With this point, I just want to extinguish the myth that people think scores matter when it comes to the unsecured funding amount you receive. It just does not. In my opinion, the determining factor for the amount you get approved is purely based on history, not score. One of my recommendations as well is to always request a limit increase once every 6-12 months. This will help in a few different ways. It will make sure you always maintain low utilization, given the fact that the higher the limits are and the lower you keep your balance. The lower your utilization will be, so always request an increase on your limits once every 6 months. Again, as a reminder, when you are shopping for financing, keep those revolving account balances below 30. When you are not shopping for funding, increase them up to 50 of the available limit. 15 length of credit management tips. A length of credit history accounts for up to 15 of your FICO score. The longer you've had credit and the higher the average age of your accounts, the better for your score. One thing I always suggest on how to properly manage this factor is finding a good unsecured credit card product with all the options, benefits, and features that work for you and maintain that card active forever. A reason why I suggest a revolving account is because every other type of account For example, your mortgage, student loan, auto loan, etc., you will eventually make your last payment. And eventually that account and trade line reporting on your credit will age off to exist on your file. But a credit card will stay on your credit report forever. The day you open it will never change, and doing this will truly maximize your benefit of this factor. One tactic that has been used before to somewhat trick the scoring algorithm to quickly age your credit profile is by using authorized user accounts. Now, this is when someone adds you as a user on their credit card with aged history. The person who owns the credit account is called the primary card holder. The authorized user may be issued his own credit card with his name on it, but the account belongs to the primary card holder. What happens also is now that the card will report on the authorized user's credit profile as well, helping to boost his score. I have used this method with a few clients before, and it is a tactic that can work. Even though I'm a strong believer in building your credit organically, meaning have your own accounts and don't rely on authorized user accounts since you have little to no control of the primary card holder's habits. With the benefits that come with the card, you also share the negative aspects of the accounts in case of high balances, payment history issues. So to summarize, the management tip for this factor is simple. Maintain the longest credit history utilizing revolving accounts, since revolving accounts can stay active forever. 10 types of credit management tips. Creditors may want to see that you can handle various types of credit accounts well. This is why I believe that 10 of your credit is based on the diversification of your credit portfolio. Rules and tips on this factor are pretty simple. As you grow your credit, you want to have different types of accounts. There are multiple types of accounts that report on your credit, including installment loans, which include auto loans, personal loans, student loans, mortgage loans, revolving accounts, which include bank cash cards, retail credit cards, station credit cards, Helicat home equity line of credit, negative accounts, collections, judgments, tax liens, bankruptcies, other or open, phone bills, utilities, note. These other PAM types of accounts typically are not always reported on your credit report. It all depends on if the companies choose to report to the bureaus. Also, recently, credit bureaus have started allowing the consumer to participate in self-reporting such accounts. Now, as odd as this sounds, I believe this factor calculates the diversification of all these accounts. Even the negative accounts all affect up to 10 of your credit. I could be wrong, so let me explain. In my experience, with over 13 years in the industry, I've noticed with previous clients that we have coached in our consulting program that removal of a negative account, especially if it was an aged account, will lower their score. My only educated guess with all the files I have seen this happen to is the negative item that was removed was the oldest item and sometimes was a big primary trade line on these credit reports since they did not have many accounts. My thinking is that if 10 of your credit is types of credit and 10 is the age of the file, removing an account, even if negative, will affect the score. Now, of course, I'm not suggesting here to accumulate negative accounts and rack up on collections, but I am trying to illustrate how the FISO scoring algorithm works. And with this understanding, you can make the necessary changes on your credit to make the system work for you. Closed accounts can be reported on your credit report for 7 years from the last date of activity on the trade line. And now that can be great news. If you have paid off accounts with a positive payment history, and you can benefit from the diversification factor as you continue to benefit from the payment history as time goes on until it fades away from your credit report. 10 inquiries. New credit management tips. A high number of inquiries within a short period of time can hurt your credit score, but not all inquiries are the same. It's important to understand this first. So you can properly manage this factor. You should know that there are two types of inquiries, soft and hard. Let me explain. Soft inquiries only occur when you check your own credit with a monitoring service online or when lenders you currently have open accounts with are conducting periodic reviews that you agree to with your membership. Soft inquiries can also occur when you opt into pre-approved offers with credit, auto, and insurance companies. This is when you receive something in the mail that says you have been pre-approved. Sometimes that lender has pulled a soft inquiry on your file for that pre-approval. Now, good thing is soft inquiries do not have any negative impact at all on your credit score. Actually, as I recommend to our clients, everyone should maintain a monitoring service so they can periodically check their own credit reports. It's a great habit to develop, and maybe just check it once every month. Regularly checking your credit report can help you monitor your accounts and help you recognize inaccurate or misleading information or suspicious activity on your credit before it's too late. Visit www.3patssolending.com to see who we recommend as the preferred monitoring service for your credit. On the other hand, hard inquiries occur. When you are seeking funding, and credit companies or service providers review your report because you have applied for credit or service. This does and can have a negative impact on your score if you have too many inquiries within a short period of time. I always recommend that you keep the inquiries at a minimum. If you do not want to have more than 6 inquiries on your credit report within a 6-month period, more than 6 inquiries on your credit report in less than 6 months can start to negatively impact your score. This applies when you are shopping for funding and not seeking funding. I always suggest, especially if you are shopping for a car, do not fill out the application at the dealership. Get your own financing directly with a lender first, then go shop for a car at the dealership. Consumers have been tricked into thinking that it's in their best interest to get the best deal by going with the dealership's preferred financing. This is simply false and applies to car dealers, equipment dealers, or any vendor that claims they offer financing. What they do is partner with multiple funding companies. Then you apply, they will blast your application to multiple funders who each will pull your credit report. The dealer usually will choose the lender that pays them the highest commission, not the one with the best terms for you. So as part of managing this factor, Control pulls your credit by always having your financing terms negotiated directly with the bank of your choice.